Howdy everybody, Brian here, quantlabs.net. Today is the 31st of March. We are looking at the time of 14 something or other, 2 to 3 p.m. Eastern Standard Time, doesn't matter. Anyways, I've done an analysis on the markets, and I think we're on the cusp of something big on the negative side. Let me just show you what I mean. It's usually to do with, let me just show you Brent crude here. Brent crude is looking pretty flat. So we've heard the Biden speech on the National Reserve, Security Reserve of the U.S. I'm just blown away that they're actually doing this during a war with Russia, unless they're indirectly not saying, but they're probably going to have a war with Russia, and maybe they need to tap into the energy emergency supply, but they're not saying, oh, by the way, we're going to go after Russia, or I don't know, something like that. But here we are. Oil, as you can see here, 4-hour chart's not performing at all. Let's look for gold. It doesn't matter which country. Well, let's say, I think it matters in the US dollar. So we want XAU, USD. So this right here, you can see it's very flat. Now, that may be due to the markets. I mean, I'm going to have to tell you, I'm listening to all these fancy schmancy analysis online, Bloomberg, whatever. You may have just come out of a bear market rally, and the bear market returns, because there's so much negative bad news out there. A lot of it has to do with national debt. Okay, when you get 30 trillion plus, you cannot tell me that's not going to cause inflation, because that's the real root cause of it all. They can make all the excuses up in the world, but they're not talking about it. Only the Republican conservative politicians, the smart ones that are based, are picking up on that. So here you can see virtually no performance on the gold and US dollar. So that, you know, there's a little bit, you can see it spike up until March. Okay, 1800 to, what's the price here? 20, so about 10% increase over a month. So that's not bad. But obviously crypto is where you can get better returns. You can get that in a few hours. So this is where we're at right now, both crude and oil right here. There's your oil. Let me just show you this price here as well. It is spiking, but you know, that's not a, I mean, it's a good place to be, but it is volatile. So the trading baskets that I just generated is low volatility and no, it's not correlated to each other. So this is a monthly chart, which I should mention. Here's the daily. You can see here it's starting to go very volatile, and one of the things that was said was that U.S. oil producers are not going to go into building infrastructure or tapping into shale because they start producing, that increases supply, which drops the price of oil, and they don't want to be left with a glut of oil months down the line, so they may not be too excited to do that. So that's where things are at right there. So gold and oil are not performing the way they should. I'm going to just show you again the daily performance of gold, so that you can see it's been very flat. So call it what you will. This is where I like the one that I do like, that I find is very reliable, is this right here, XAG against XAU against XAG, which is the gold silver ratio. So again, this is a daily, so it's been very flat, but if you look at the hourly, you can see it start to trend up a bit, and that's a bit of a spike. Okay, that's not normal. Usually it's fairly flat, but you can see that big spike right there, whatever the news item was for that time. But generally, this is what you look for to know overall economic conditions. Right now on the daily, It's been very flat, stable. I've shown this before when the pandemic hit. You can see what happened here, February. This was right here, February, March of 2020, and it dropped back and it's gone stable. But generally what you see here on the gold silver ratio, it has been spiking. Here's what happened in 2008. So it reached that level at 78, 79, and it creeped up normally up to that level, and it broke through in January 2014, and it continued to move up, meaning there's more risk in the market beyond what the risk is measurement of what it was in 2008 with the financial crisis. So right from this point, this happened because of over leverage in the housing market. Here, we're already there, and we're beyond it. We spiked here, came back down, and we're now at pretty close to 29 pre-pandemic level. And you can see that big spike right there. So something's happening. I can't sit here and say, and the other reason I can confirm it is by looking at the treasuries of the US. Now, the US dollar has been spiking, okay, and a lot of other, so let's say if I pull up the US Treasury, I can't even remember the symbol name because I barely see it. This is another one that should be spiking normally. Let's see here if I can find it. But it's been declining. All the treasuries have been really, really declining pretty bad lately. So let me just find it. Okay, right here. So this is a 5-year. So when you look at just generally, let me pull up weekly probably. You can see here actually monthly might be better. So this is a 5-year. Okay, we heard about the inversion rate with the 2-year, 10-year, whatever, however they measure it. You can see here, this is when U.S. had some credibility. Okay, so up until 2007, you can see here all the way back to 2003, the U.S. Treasury for 5-year bond went down as the U.S. markets got much stronger into 2007. So right here, that just shows you as a market, U.S. market economy really was strong back then. Yeah, we would expect the U.S. Treasury to go down because this is considered a safe haven trade, so you wouldn't invest into a safe haven during the good times of the U.S. So it stabilized between here, 2006 to here to 2007 in June, over that year. So it stabilized, but it started to spike over July 2007 to right about here, September 1st, 2012. So it spiked during, right, especially here in 2009, during these financial crises in 08, 09. So that's expected. We expected the U.S. Treasury bond to go up because the credibility of the U.S. economy, the U.S. dollar, the Federal Reserve, and the debt situation was very manageable at that time. Okay? So that's what we expect. But look what's happened since 2013. Now these are charts that you cannot lie. You can see here it's dropped back. Okay, it's dropped back a little bit as the economy got better, and it started to spike, right? So right here in 2019, it started to spike already. What drove that up? I don't know. It shouldn't be going up. This is when the market started to get distorted as far as I'm concerned. Right here. And it started to really, really spike here, March 1st, 2020. Okay, obviously that's when the pandemic hit its peak in the early stages. And look how fast it's dropping. Okay, so the U.S. market is in trouble. They've been really inflating the U.S. debt with the spending on a variety of programs, I guess, to support the effects of this virus. And then it stabilized a little bit, but it's very high. And then it just started to tank here. And it's tanking here very quickly because this is where the U.S. dollar is starting to die. So when you look at right here in the last March 2000 of this year, 2022, it really dropped. So that's telling you it started dropping here around July 2021. Okay, this is when it should drop as the economy gets stronger. But it's not dropping because of historical reasons. I think it's dropping because, well, you've now gone from, I don't know, 20 trillion to, or low 20s to 30 trillion plus on the books of the US Fed. And look what's happened. So this right here, this is where it's dropping. And even when you look at the volume levels historically, only back here it's kind of really for 2 months the volume in red has spiked a little bit. But look at that gradual drop and the acceleration of that drop on the price of the US 5-year. So this is telling you people are losing confidence in the US in terms of credibility. So this is starting to happen, and it's going to get worse. I think you'll start to really see maybe, just maybe, gold spike because of this, and maybe oil as well. I don't know. But there's something definitely happening financially, credibility-wise, with the US. Okay, so if I was to pull up the 10-year, which is the standard one, I'm sure I can see the same pattern. Now, for anybody out there that wants to poo-poo this, I don't give a flying F about what people say. I've been following the markets for a long time, and if you can't see this historically all the way back to 2003, that's going back 17 years. That's pretty good history considering all the different boom and bust times the US has had. But this right here is the same pattern. A little higher volume here, but this is the standard 10-year. But something's going on, okay? For this to collapse like that, and the overall US economy, I mean the stock market may have gotten stronger, but remember, for the last 3 months this year, the markets have been negative, okay? I mean, I just did let me see if I still have it. Yeah, right here. Let me just show you this. So I just did this video, okay, of the U.S. markets, right? But here, look at the returns on the S&P 500, okay? We have, for the last year, 15%, okay? But when you look at the last month to date, it's 4.78, which is fine for this month, okay? But when you look at the last 3 months, it's down negative 4.06, down 3.67 for the year. So there's probably still some pressure in the U.S. markets, but something is definitely going on. And even my system that I use to get this type of performance is not picking gold, it's not picking oil, it's picking other things. Okay, and I've shown this in another video, but, or did I? Well, here's this video about this trading basket I just generated today. Look at this, 34% for this month, okay, and fairly strong for last year except for this month, or the month of November and the month of February. But again, when I do these net, these are still way higher than what you get in the markets, U.S. markets. It does have a few overseas indices, market indices, but they're very, very low percentage. A lot of this is driven by currency, and shockingly, and remember, if you've known in the past, it generally generates the overall weighting on the allocation of those instruments. So right now, this would be low volatility for that year or for last year, except when there's some kind of magical crisis of some kind that's very sensitive, but you're still beating out the market. And I just generated one a while back, I think earlier this week, but this is a really good one because it's 10 times the performance. 10 times the performance of what you get with the S&P 500 for the last well, pretty close to 10 times, right? But if you figure out the CAGR, the compound annual growth rate, it's 10 times. So that's pretty good, and I'm generating these day in and day out. Well, I could if I want, but these combinations are pretty impressive, and this is all mechanical. It's not like I go out and pick and choose. Well, actually, I do pick and choose them using my methodologies, but these are the kind of returns we're getting. So again, if you want to know more how this works, quantlabs.info. Oh, sorry, that's my chat server. Quantlabs.net contact. Okay, so if you want to get in on that, you want to get quantlabs.net/contact. I'll put that in the description, and I'll follow up where you can go to get other info on the chat server as well as my Telegram. But I do think we are hitting some kind of precipice. We are definitely on the abyss of something not pretty. Okay, they've already started talking about potential food shortages in the fall. I mean, it makes sense with Ukraine and Russia, all that going on. But there could be problems. I have my opinions on it that are way more than this, but you know, our overlords called YouTube wouldn't like the video otherwise. But we'll leave it at that. But I usually base everything I see off of data and charts, and this is my latest, which is today. All right, thanks for watching. Have a good day. And again, that email to get on the list, quantlabs.net/contact. We'll leave it at that. Thanks for watching.